Stop what you are doing, put down whatever you are reading, and look at the calendar. Today is April 5th, 2026. Exactly 1 year ago today, the first of Trump's Liberation Day tariffs went live, a 10% minimum on nearly all imports to the United States. The largest tariff shock since the 1930s. On April 3rd, 2025, the Nasdaq lost 1,600 points in a single session. The S&P 500 dropped 10% in 2 days. Over $6 trillion of paper wealth evaporated in 48 hours. It was the single largest two-day loss in the history of American markets. And in that exact moment of maximum financial panic, while people were liquidating everything they owned, something happened to silver. It went higher. That was 1 year ago. Today, something far more important just happened. Ladies and gentlemen, this is John A.G., and what I am about to walk you through is not a prediction. It is arithmetic. Let me give you the 3 numbers you need. The first number is 13.5. That is the current coverage ratio at the COMEX, 13.5%. For every 100 paper ounces of silver that exist as futures contracts and outstanding claims in the system, there are 13.5 ounces of registered physical metal actually available for delivery. Not eligible metal sitting in someone's private account, registered metal, metal that can be handed over today. Below 15% is stress territory. Below 15% has historically been associated with delivery squeezes. We have been below 15% for weeks, and the drain has not stopped. In the last 30 trading days, 11.6 million ounces were withdrawn from COMEX registered vaults. That is a 13.2% decrease in a single month. February delivered 5,036 contracts, 25.18 million ounces, the highest February delivery volume in the modern history of the exchange. The pace has not normalized. It has not even slowed. It has continued month after month after month. The second number is 60, as in 60 basis points. That is how much Federal Reserve easing financial markets are currently pricing in by year-end. Jerome Powell, the man who has spent the last 18 months insisting that rates must stay elevated because the inflation fight is not over, just delivered what Bloomberg is calling fantastic news for stock market investors. I want you to understand what that means in the context of silver. Powell cannot raise rates meaningfully. He has been trapped since the Iran war pushed oil to $110 a barrel, locked inflation above target, and simultaneously frozen the Strait of Hormuz, which carries 20% of global oil and gas supply. He cannot raise rates into a stagflationary oil shock without triggering a debt crisis in a government that is already spending over $2 trillion a year just to service its existing obligations. So he held. He held at 3.5 to 3.75% in March. And now the market is pricing in 60 basis points of cuts by December. That is not a signal that inflation is beaten. That is a signal that the Fed has quietly surrendered to it. And when the Fed surrenders to inflation, hard assets win. Every time, without exception. The arithmetic is not complicated. The third number is 73. That is where silver is trading today. $73 an ounce. Let me give you some context for that number. 1 year ago today, silver was trading at approximately $32. That means even after the historic 42% correction from the January 29th all-time high of $121.67, silver is still up over 128% in 12 months. Meanwhile, the S&P 500 is up somewhere around 12 to 15% over that same period. Bitcoin is negative on the year. The asset that half the internet spent 5 years telling you would make silver obsolete is the only major asset with a negative number on the scoreboard. And silver, the so-called pet rock, the relic, the thing they told you had no future, is up 128% and currently consolidating above its 50-year structural breakout level. Now here is what nobody is connecting. Here's the layer that the mainstream financial media is completely ignoring because it would require them to admit several things they cannot afford to say out loud. 1 year ago today, the tariff regime that was supposed to bring manufacturing back to America, weaken the dollar, and force trade partners to capitulate went into effect. What actually happened? The Supreme Court of the United States ruled those tariffs unconstitutional. The administration is now trying to reimpose them through different legal mechanisms, pledging a 15% global tariff to replace the previous structure. The legal outcome is in flux. The uncertainty is permanent. And uncertainty about the currency value of the world's reserve asset amplified by an Iran war that has closed the Strait of Hormuz, amplified by a Fed that cannot raise rates without detonating the bond market, amplified by a government running a $1.85 trillion annual deficit. That uncertainty is the jet fuel for everything that has been driving silver higher for 18 months. Connect those dots. The Fed is trapped between inflation above target and a debt load that cannot survive genuine positive real yields. The government is running deficits that guarantee ongoing currency debasement. The tariff structure is legally challenged and economically regressive, with Goldman Sachs confirming that American companies and consumers paid 82% of the cost. The Iran war is not resolved. The Strait of Hormuz is not reopened. And the physical silver market, the market that actually delivers metal to industrial buyers and sovereign entities, is operating at a coverage ratio of 13.5%, which historically has been the warning light before a violent delivery squeeze. I want to be precise about what a 13.5% coverage ratio actually means in practice, because this is the kind of data that gets reported and then immediately forgotten. At the current withdrawal pace, which has run above historical norms for 6 consecutive months without normalizing, registered silver at COMEX exhausts in approximately 131 trading days. That is fewer than 7 months from today. 7 months. And April 1st, notice day, the next critical delivery period, was 3 business days ago. There are already 1,830 open contracts on the April cycle. 22 million ounces of incoming physical demand. The same entities that stood for delivery in January, February, and March have not changed their behavior. Supply chain managers do not roll contracts because the price is down. They take delivery because they need the metal. Because solar panel manufacturers in South Korea and electric vehicle battery producers in Germany and semiconductor fabs in Arizona need physical silver, and they cannot substitute aluminum or copper into a circuit board. And now we have to talk about Turkey, because Turkey is the thing that explains more about this market than any chart I can show you. Bloomberg reported this week that the Turkish central bank sold and swapped approximately 60 tons of gold in just 2 weeks since the start of the Iran war. 60 tons. A government liquidating its sovereign gold reserves to defend its paper currency. And a photographer captured a jeweler in a Turkish town with 3 handwritten signs taped to his shop window. The first invoked a sacred oath, swearing what he was about to say was the absolute truth. The second said, 28 years as a jeweler, first time there is no gold. The third said in large letters, if we had it, we would be selling it. A man did not write a research report. He taped 3 pieces of paper to a window. And those 3 pieces of paper contain more clarity about the state of the physical precious metals market in the spring of 2026 than 80% of the analysis being published on financial terminals. When a government sells gold to defend its currency and a 28-year jeweler cannot source inventory, the empty display case and the COMEX vault drain are not 2 separate stories. They are the same story told from opposite ends of the supply chain. And here is the cruelty of the mathematics at this stage. The Fed's own pivot signal, the 60 basis points of easing the market is now pricing in for year-end, does not solve the physical supply problem. It makes it worse. Easing means more dollar debasement. More dollar debasement means more institutional reallocation into hard assets. JP Morgan's own strategists are on record with a gold price target of $8,500. If gold reaches that level, and the historical gold-to-silver ratio even partially normalizes from its current 64-to-1 toward the 50-to-1 level we were at in January, silver at $73 is extraordinarily cheap. The math is not exotic. It is multiplication. And the multiplication says that the 42% correction you have been watching over the last 2 months is not the end of the story. It is the compression phase before the next release. I want to be honest about what is still in play on the downside. The Iran war short-term dynamic is genuinely bearish for silver through the oil price inflation rates channel, and that has moved silver from $93 when the war started on February 28th down to $73 today. That is a real 22% headwind. The dollar got a new lease of life from the Warsh nomination, and Warsh historically has been hawkish enough to freeze rate cut expectations if he assumes the chairmanship. Those are real risks. A continuation of Western speculative liquidation through leveraged accounts could push silver back toward the $65 to $68 range before the physical floor reasserts. I am not dismissing that possibility, but here is what I cannot dismiss. The structural supply-demand reality has not changed by a single ounce because of geopolitics or Fed nominations. The solar transition is still accelerating. Britain mandated solar panels and heat pumps in all new homes this week, citing the Iran war explicitly as the catalyst. The head of the International Energy Agency stated that nations are pivoting to renewables as a geopolitical security measure. Every mandate, every pivot, every policy declaration is an additional silver demand unit being written into the industrial economy for the next 25 to 30 years. Because silver in solar cells is economically unrecoverable once it is installed, it leaves the supply chain permanently. And the China export controls announced in December are still in effect. Every ounce of Chinese silver that does not reach Western markets is one more ounce of demand that has to be satisfied from an already draining COMEX. Here is your framework for the next phase. Silver at $73, with a coverage ratio at 13.5%, with the Fed signaling 60 basis points of easing, with industrial demand being legislated into acceleration across NATO countries, with the Iran war sustaining the structural stagflation case, with 6 consecutive months of above-historical delivery demand, is not a sell. It is the coiled spring. The compression from $121 to $73 has not changed the breakout. The 50-year ceiling at $50 was broken in October 2025 for the first time in history. The price corrected 42% and is still consolidating above the breakout level. The structural buyers are not waiting for the price to stabilize before they act. The vault is still draining. April delivery is still incoming. 1 year ago today, the tariff shock went live and the paper market fell apart in 48 hours. Silver went higher. Today the coverage ratio is at 13.5%. The Fed is signaling the pivot. The vaults are draining. The industrial mandates are accelerating. And the man who called $100 when silver was in the 60s is now on record saying the next destination is $300 to $500. I do not know the timing. Nobody does. But the framework is logically consistent. The physical data supports the fundamental premise, and the 12-month performance numbers make it fairly clear who has been reading this situation correctly. $73 is not expensive. $73 is the last level the paper system can hold this price at, and the paper system is running out of physical metal to hold it with. This is John A.G. The clock started 1 year ago. It has not stopped. Like, subscribe, and I will see you when the next delivery data lands.